In this video, we are going to look at aggregate output and the various forms of income. Let's start with gross domestic product. The GDP of a country is the sum total of the market value of all final goods and services produced in a region within a particular time period. Within the GDP figure, as well as the market values for the final goods and services, we need to consider the rental value of all housing which is occupied by the owner. And we also need to factor in any cost of any government services which create economic value. Remember that some government services are really just moving money around to facilitate certain government functions which do not actually create economic wealth, so they wouldn't be considered here. Social welfare is an example of that. There are two approaches to the calculation of GDP, the income approach and the expenditure approach. The income approach is a simple concept which looks at summing together the household savings with business income and government income to get the total GDP. This can be represented by this simple equation where we add the savings of individuals to the consumption spending received by businesses to the tax revenue earned by government, and we get GDP. Under the expenditures approach, we express GDP as a combination of consumer spending, business investment, government spending, and net exports. This is a very important relationship used frequently in the economics material. Now, to calculate the value of GDP under the expenditure approach, we have two methods. We can either look at the sum of value added method, or we can look at the value of final output method. In this example, we are looking at the various stages of production for a baked goods product for a coffee shop. So we start with the production of the raw ingredients, delivery of the ingredients to the bakery, the actual baking process, and finally then the sale of the product in the retail outlet. Under the sum of value added method, we can look at the increases in value through each stage in the production process, adding up the value added by the producers of the raw ingredients, and then delivery, and then the baking process, and finally the value added by the retail seller. We can calculate the total value added, which counts towards our calculation of total GDP. Alternatively, we can use the value of final output method and sum together the market values for all final goods and services produced within an economic region. We ignore the value being added through the stages of the production process and focus on the final value of the product. From the table here, we can see that each of the two methods for calculating GDP by the expenditure method should be the same. Next, we will compare nominal and real GDP. Nominal GDP is all about calculating the value of final goods and services produced by an economy using the prices of the current time period. Real GDP takes the quantity of final goods and services produced within this time period and calculates GDP based on the pricing structure of a base year. Now, why would we want to use the pricing structure of a different time period? When nominal GDP changes from one period to the next, the change will be made up partly of the effect of how much the economy has expanded and partly of how much prices have inflated. The real GDP figure strips away the effect of price inflation and will only increase if there has been an actual increase in the output of the economy. With real GDP then, we are looking at the change in the amount of output, rather than with nominal GDP, which is a representation of the change in dollar value. The GDP deflator is an index value we use to convert nominal into real GDP. To calculate it, we divide the nominal GDP at current prices by GDP at the base year's prices, real GDP, and multiply by 100. In the base year, the GDP deflator will be 100 exactly, because in that base year, both the nominal and the real GDP calculations will be done with the same pricing structure. Finally, then, let's look at some different types of income. First on the list here is GDP. So here we can express GDP as national income plus a capital consumption allowance plus a statistical discrepancy. Okay, now the capital consumption allowance is an amount spent on capital stock to replace anything that has experienced a significant reduction in its production capacity. This is similar to economic depreciation. We're talking about money spent to maintain production at current levels, so to overcome any imminent drop in production. The statistical discrepancy then is just a plug figure to deal with the fact that if we calculate GDP using all of the various possible methods, we are going to get small variations in our answer. We will take a look at national income in a little more detail next. National income is a measure of the various types of income earned within a country. Incomes which are earned in the production of that economy's output. This will include wages and benefits earned by company employees, the pre-tax profits of corporations and government entities, the incomes of any unincorporated businesses, rental incomes, interest incomes, and then adjustments for taxes and subsidies. Now, why are we adding in taxes? Well, remember that when we see a sales tax on a product, the business is not actually receiving that money. So if I buy a product today for €50 and €5 of that is sales tax, then only €45 actually goes into the revenue for that company. So if we only counted the revenue of the company in the incomes of unincorporated businesses portion, we would actually miss out on that €5 of spending, which is actually happening. Next, we have personal income. Personal income is a measure of how much the national income actually gets to consumers. We take our national income and first of all we add in transfer payments, so anything like welfare payments or unemployment benefit. Then we need to remove incomes which do not get to individuals, which would include indirect business taxes and corporate income taxes which are kept by the government, and any profits which a corporation makes but does not distribute. Finally, then we have personal disposable income. This is simply a measure of how much after-tax income people have to either save or spend. This is a significant indicator of consumer spending because if consumers have more after-tax disposable cash, they may choose to spend it. It is simply calculated as gross income minus personal taxes payable.